coronavirus outbreak weighing on the markets yet again. Stocks extending yesterday's steep losses. Now we have Nomura. They were out with a new prediction, warning about the potential impact coronavirus could have on the economy. Joining us now is Lewis Alexander, Chief U.S. Economist at Nomura. And Lewis, thanks so much for joining me today. When we talk about the potential impact that the virus can have on the economy, you laid out three different scenarios. What are they?
So there's our base scenario, which is our basic forecast, which already incorporates an awful lot of corona effects. So for example, for China in our base scenario, we're assuming GDP is going to be essentially flat year on year, which means down 4% in the first quarter. We then have a bad case, which would essentially extend the effects in China. It has larger effects abroad. And then there's a severe case, which assumes a prolonged scenario in China, much wider spread globally. So there's a lot of uncertainty about just how bad this is going to be.
There is a lot of uncertainty out there, but when you're trying to forecast, trying to gauge the potential economic impact, do you see this still overhanging or still being an issue, I should say, in the second half of the year?
So we think there's going to be a strong recovery. I think when you look at the history of these things, say, for example, if you look at how the SARS epidemic played out, even if you go all the way back to the global flu pandemic in 1918, 1919, they are very disruptive in the short run to economic activity. But the thing that's different about these things from other things that generate recessions is the recovery on the other side is pretty strong. So if you look at where we think the global economy is going to be in the fourth quarter, it's essentially back on track.
Lewis, since we have you, there's obviously been so much volatility in the markets. We've been talking about the 10-year yield, what we've been seeing there. So obviously there's been lots of demand for treasuries, putting the pressure on the yield. Today we have the yield hitting another record low. I mean, is this anything that you thought that you would see happen just in terms of the levels that the yield continues to fall to?
We didn't forecast this, but the dynamic that you're seeing at work is one that I think we have seen playing out really over the last 18 months. At the end of 2018, when we had that sort of shock and confidence and it looked like we were going to have a recession, you did see the 10-year Treasury move from something like 3% down to 1.5% relatively quickly. That reflects the fact that treasuries are a good asset to own if you're facing downside economic risks. People are increasingly realizing that. So when there is a threat to the economy, those assets look more attractive, and that's what's driving the treasury market.
Lewis, what did you think of the Fed's decision earlier this week to announce an emergency cut, reduced rates by 50 basis points? Do you think that was the right move?
I do. I think markets were moving very rapidly. There was obviously a big change in the economic outlook. And to some extent, if they had already made up their minds that they needed to react to it, I don't think there was a good reason to wait. So I think that was the right decision.
Do you think we could see, or do you think we'll likely see the Fed cut again, maybe later this month?
Our expectation is that we're going to get another 50 basis points, probably 25 at the March meeting and then again at the April meeting. But this is a very dynamic situation. It's going to obviously depend on how the information about the virus outbreak plays out. It's what we learn about the economic consequences of that, and obviously how financial markets react. So that's our base case call, but obviously it's going to depend on how all those things go.
And Lewis, what was your thoughts on the jobs reading that we got this morning? 273,000 jobs were added in the month of February. We had that unemployment rate tick down to 3.5%. Do you think that this is just kind of a calm before the storm, meaning that we could see a huge fall off in the March number?
Well, first of all, the nature of that report is it reflects where labor markets were in the second week in February. That's pretty much before this really became the global event that it is. And so from that perspective, you shouldn't have expected that number to really reflect things. We think weather played a role. The winter has been very mild. That means, in some sense, employment has been stronger in things like construction and some of the leisure and hospitality areas in both January and February. That does create downside risk going forward. One of the things that's going to offset that, oddly enough, is we're about to get a big ramp up in hiring by the census for the 2020 census, which is going to make the jobs numbers pretty complicated to read in coming months.
All right, Lewis Alexander, thanks for joining me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.